Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. In this video, we're going to talk about a lot of different things. There's a few very interesting charts to look at. First of all, in order to give the context, let's first take a look at a very important chart here. That's a representation of 12-month expectations of what the US economy is going to look like. And here are the results. In the vast majority of cases, 37.7% investors are expecting inflation and a recession over the next 12 months. Now, there's a lot of reasons to believe that, right? And it makes sense. We have the yield curve that's inverted. That's a leading indicator of recessions. We're going to talk about that in just a second. And of course, we have inflation that really hasn't shown material sign of coming back down. So why on earth would we be expecting inflation to go down and not even trigger a recession despite all of these recessionary risks? In fact, if we jump over to our Twitter channel at @GameOfTrades_, we post a lot of stuff on here, so make sure to follow us. We have really a historical amount of bearish sentiment here, not seen since 2009, not seen since 1990. Both happen to be massive buying opportunities in the market. So what's really going on here? There's so much bad news, and yet you have these common sayings that say, buy when others are fearful, sell when others are greedy. So what are we meant to do now, right? That's really what we try and figure out on this channel. We look at the macro, we look at the markets, and try and figure out where they're going as accurately as possible. If you're interested in following these crazy markets with us, don't forget to smash that subscribe button and also click on that like button, because it really does help give a little extra push to our channel. It makes the effort and the time that we put into making these videos, it makes it worthwhile. So it is really appreciated. Now, when you see the extent, the severity of this yield curve inversion, this is the 10-2-year yield curve. You can see right here, let me zoom out a little bit, 89, right? Famous recession of 1990, 2000, famous recession and bear market of 2000 to 2003, 2006, very well-known recession, the global financial crisis, 2019, COVID. I don't know how the bond market anticipated that. I don't think it really did. The COVID recession seems to have coincided with what should have been an actual recession. And then today, we have a very severely inverted yield curve, very important signal of a recession. If you're not yet convinced, let me put up the unemployment rate on top of this chart, and you're going to see this is about as clear of a relationship as you can see. Unemployment is low when the yield curve inverts and goes up as it steepens. It goes up as it steepens. It's low when the yield curve inversions occur, and then unemployment goes up as the yield curve steepens again and again, and probably it's going to happen again. This is really what our next big concern is on the market. It's a recession. That seems like consensus right now. Back to this chart here, 12-month expectations. It's pretty consensus that we're going to be in a recession over the next 12 months. And I think that makes sense. Just based on the 1-year yield, you can see that the massive shock we had in monetary policy, an extreme tightening of financial conditions, that's going to materialize into a weakening economy. Just like it did in 2008, just like it did in 2000, just like it did in 1990 with this bear market. The question for me is, when is that going to happen? This is a very interesting chart. You can see we have a recession trigger right there with the percentage of treasury curves that are inverted that spiked to 50%. And you can see in the 4 previous cases, it did lead to a recession. But what I found interesting about this chart is look at the number of days right here. This is 322 days between that signal and the start of the recession. Almost a full year. In 2008, this signal was triggered a year and a half before the beginning of a recession. And then we're going to take COVID out because COVID precipitated the recession. So I think it's fair to say that we take it out. So that's really what our current approach is at GameOfTrades.net. We think inflation is going to come down here, and that's massively bullish for the market. And a lot of investors are underestimating that massively, right? The power that inflation coming down has on the market can be absolutely massive. And you can see 1990 inflation coming down, stock market going up. 1980 right here, inflation peaking, stock market going up. 1974, stock market going up as inflation comes down. So we think we're there. We're in that phase where we're going to have that massive tailwind. But as time goes on, the probability that we see an actual recession with, for example, the unemployment rate that starts to rise, which it hasn't done yet. None of that is priced in. We haven't seen a real recession yet. A lot of people are saying, we're in a recession right now. Things are already looking very bad. No, that's not the case. Things can get a lot worse from here. None of this is priced into the market, right? And that's why the markets are still very high. And in fact, they could go a lot higher. But something we need to keep in mind, and this is just our approach, and you can leave a comment down below what you think is the best approach and what you think about our approach. But how we're thinking about this is coming likely in the next 1 to 2 years. So we need to be on the lookout for it. We need to be hedged appropriately for that type of environment in case it comes sooner than expected. And when we think it's the right time to really strike, we want to be betting that things are going to go down in a big way. It's like a ticking time bomb, and our goal is to try and observe all the signals in the market as best as we can to try and take advantage of both the market environment that we have today with inflation coming down and the environment of tomorrow, where S&P 500 earnings, weak economic activity is going to be a big tail risk to the market. So we are going to be communicating that through our model portfolio that really represents exactly what we're thinking about what an ideal positioning looks like in today's environment and how we're hedging against being wrong. Because yes, we're trying to time things, we're trying to understand how and when a downturn could come, but perhaps we'll get that timing wrong, and so we want to be hedged against that type of environment. And that's exactly why we want to have this model portfolio to represent both our thinking and also how we're protecting ourselves against that in the best way possible. And of course, as the data changes, we're going to be changing the model portfolio. It's going to be updated multiple times a quarter with articles accompanying it, a video, and of course a notification to send you guys as soon as we're making the changes. Now on the 17th of October, we're going to be releasing the update of the website. All of this is going to be completely redesigned. We're going to be integrating everything into one dashboard. So make sure to grab yourself a free trial. Now let's quickly jump to the technical picture on the S&P 500. Take a look at the recent developments. We had a very, very oversold reading if you were with us on the website on Friday 2 weeks ago on the 30th of September. You'll know that this was a massive buying opportunity for the market, with the market breadth right here in this zone that was very oversold at the same levels we saw right here in June, which was evidently a massive buying opportunity for the months ahead, with an 18% move up that followed. So very attractive buying opportunity, again similar to the oversold readings that we got throughout the COVID crash at the bottom of it and in 2018, right? So we got that same oversold reading a couple of weeks ago, and you can see the market reaction as soon as we got some good news regarding job openings that are showing signs of cooling down. We got a big, very powerful move up. Most powerful move we've seen since COVID, actually, accompanied with a MACD bullish crossover here. So that by itself was very promising, right? First bullish crossover in momentum since June. You can see the price action we got here. Bullish crossover. Right as you get that, you kind of have a retracement right there, but the market continues moving higher without seeing a bearish crossover, which you really can't say the same thing about today. I'm going to be posting a more detailed technical update. You can see we did cross below that 61.8 retracement, which isn't very good news from a very short-term technical standpoint. Now, playing the short-term moves is very often a fool's game, right? We're investors, we're looking at the environment, looking out 6 to 12 months, but we are looking for objective long-term investment opportunities and also when to take profit on those positions. The truth is, this was an objective, very aggressive entry point. This less so from a technical standpoint. So what are the two options? First scenario, we need to watch this MACD cross here. If it holds, if you see that blue line right there, bounce back up off that orange line, that's very good news. That starts to look a little bit like this, and you can expect a more intense rally in the weeks ahead. If you get a bearish cross here, what you're probably going to end up seeing is a scenario like the one we saw right here. A lot of people are calling for a massive move down here, a rapid 10-20% move down from current levels. That is far from our preferred scenario right now. It would really need to take a lot of bad news for that to occur. Potentially a very, very hot CPI number could really spook the market in a big way. I have to agree that that could be the case, but then again, a lower than expected CPI reading could be fuel enough to take the market out of its correction. And that's the direction that we think we're heading in. Now, whether it's this month or the next or the one after that, that's a whole other question. Our second preferred scenario right now is potentially, again, something like this. If you get that bearish cross, you start to get into what the market usually does after a very oversold reading, but it's not yet ready to get back in an uptrend. Oversold reading, not yet ready to get back into a big rally mode. You'd get a contracting price action. That would be very painful to a lot of people. It would mean that the market stays low for another few weeks before moving higher towards the end of the year. We'll be watching this very carefully, and of course keeping you guys updated if we actually see anything that's relevant regarding the risk reward. Right now it's a little bit mixed. When we have an opinion, when we have a clear bias regarding the short-term technicals, we go ahead and say it. This is not one of those moments. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed it. If you did, make sure to leave us a like and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.